Okay, so in this video, I'm going to talk about the cost of common equity. So I'm going to start off with the cost of common stock, and then I'll move into the cost of retained earnings. So let's talk about common stock. So the marginal cost of common stock requires issuing common stock, which involves the flotation cost. So if I kind of start off in a similar direction as I did for the cost of preferred stock, I'm going to start off with a stock valuation model here. So what I have here is a constant growth model, or Gordon's model. And so basically I have D1, so this is the dividend I expect at the end of the year, over RS, my required rate of return, minus G. And I could plug those in to find the expected price. Or I could rearrange those. And if I rearrange those and solve for RS, what I would get would be D1 over P0, that plus G. But then if I do kind of like what I did for preferred stock, and I account for the fact that if I'm actually selling the shares of stock, then I have to pay flotation costs on it, which means when I sell the share, let's say I sell it for $50. If I sell it for $50, the company, do not receive $50. I receive something less than that because of the flotation costs. And so F is going to be the percentage of flotation costs. So 1 minus F is going to is going to show us the percentage of the sale price that the company actually gets to keep. So I take the price that we sold it for. So basically, whatever the stock price in the market is today, that's going to, what I sold it for. 1 minus F is going to be the percentage of that I get to keep. The expected dividend at the end of the year, so that's D1, over that. And then I tack on basically the growth. All right. Now, basically, a few little things here. This cost of common stock is therefore going to get higher as the flotation costs get bigger, right? So as F gets bigger, 1 minus F gets smaller. A smaller number times P0 makes a smaller denominator. The D1 divided by that smaller denominator results in a bigger number. Basically, the cost of equity gets higher. So the higher the flotation cost, the higher the cost of equity. And what that translates to for a company is, if I have to pay an investment bank to do a whole bunch of work for selling this share of stock, they may wind up doing a similar amount of work, whether I sell 1 million shares or 10 million shares, which kind of means I wind up paying them the same amount of dollars, whether I sell 1 million shares or 10 million shares, it kind of basically says issuing small amounts of shares is expensive because I incur like all the same costs as issuing a lot more shares. But on a percentage basis, the flotation costs are going to be much, much worse because I didn't raise as much capital. So what that tends to push us to is basically, if I am going to sell shares as a company, I want to sell a lot. Because if I sell a lot of shares, then I basically spread out those flotation costs, and on a percentage basis, it doesn't feel as expensive. So basically, I don't want to sell small amounts of stock. That's a bad idea. If I'm going to sell it all, I'm going to sell large amounts. So from a cost standpoint, we have an incentive to basically issue lots of shares if we issue. But really, because of the cost standpoint, we'd kind of rather not issue at all. We'd rather use retained earnings. But also signaling theory is kind of important. So let me give you sort of a brief idea about that. So here's kind of a thought. Let's suppose you had a business idea that you thought was going to be big. I mean, like super massive. Incredibly valuable. Like, it was going to be a multi-billion-dollar company kind of value. If you had a choice to turn it into that multi-billion-dollar company by issuing stock or by borrowing money, which would you do and why? Well, if you're thinking like, well, I'd probably borrow money if I could, then that kind of makes sense, right? Because if you sell stock to other investors, then basically you're giving away a piece of ownership. So now you don't own that entire multi-billion-dollar company. You own a small slice of it, right? So you might not necessarily want to give up ownership. You might prefer to borrow instead if you could. Now, as a result of that, companies tend to not like to sell a lot of shares of stock because it's basically giving away ownership. It dilutes the ownership of the current owners. And so we kind of have incentives to not sell a bunch of shares unless we really need to. And the companies that tend to really need to would be companies that are growing so rapidly that they just need money from everywhere. And so basically that's why they have initial public offerings, IPOs, and why they might borrow money, sell stock. I mean, they're doing it all because basically they need capital from everywhere they can get it. So generally speaking, unless you're dealing with an IPO kind of situation, you tend to not see a lot of established companies out there issuing a bunch of shares, basically because it kind of dilutes ownership and things like that. And also, if you had a choice to expand, you probably borrow if circumstances were favorable. And what that means is the company that might actually be issuing stock might be in a situation where the circumstances are not favorable. For instance, company wakes up one day, they come to their senses, and they kind of realize we got way too much debt, and we're on the edge of going bankrupt here. Well, if that's the case, they might be thinking we need equity, and then they're selling stock. Well, in that case, if they're selling stock and it's a company that's on the edge of going bankrupt, well, that's not a real favorable circumstance. So that can send a signal. So if I have a big established company that is selling stock, that can send kind of a negative signal potentially. So firms tend to be a little bit more cautious about selling lots of shares of stock. Now, that brings us to the cost of retained earnings. So let's review retained earnings. Basically, a company, if they make net income, so if they have a profit, that net income belongs to the shareholders, and the company can either pay it out as a dividend to the shareholders or they can retain it. So every dollar of net income either goes to dividends or to retained earnings, right? So the money belonged to the shareholders because it was the profitability of the company, and the shareholders own the company, so the net income belonged to the shareholders. If the money was kept in the company, then that's the retained earnings. Now, retained earnings are therefore an investment by the investor. They incur an opportunity cost to the investor. The investor could have used that money to do something else. So that is something that we need to factor in. Basically, this is not free money to the company. The company has to earn an acceptable rate of return on this. However, retained earnings do not involve flotation costs. We don't have to pay an investment bank or anything like that for the retained earnings. All I need to do, sell my product or service, make a profit on it, not pay a dividend. We got retained earnings, right? So as a result of that, the cost of retained earnings is generally lower than the cost of issuing common stock. And as a result, when you look at large established companies, very commonly, they're much more likely to fund growth by using retained earnings as opposed to issuing new shares of stock. Now, a little bit of an exception to that would be if I had a smaller, rapidly growing company that needs capital from everywhere, they are probably going to use all the retained earnings they can get. They probably aren't going to pay much of anything for dividends, and they may actually sell stock by having an IPO because basically they need capital from everywhere. But for a lot of the big established companies, not uncommon for them to just not really sell a lot of shares of stock. They get equity through the retained earnings. Now, there are a variety of different approaches for calculating the cost of retained earnings. And this is kind of like if you stuck a thermometer outside. If you stuck a thermometer outside and you looked through your window and you looked outside, it would tell you, what the temperature is. But if I just had one thermometer out there, there's a chance that that thermometer could break and get stuck on a number or something like that, and or have error in it, and we wouldn't necessarily know that it got stuck until I stepped outside. So maybe the possible solution to that is, we could stick 5 thermometers out there. Well, if you stick 5 thermometers out there, maybe those big outdoor thermometers with the big hand that moves around, right? So if you stuck like 5 thermometers out there, they probably aren't all going to tell you exactly the same number, but they're going to they should all be pretty close, number one, which would mean you have a really good idea what the temperature is. But also, if one of them broke or got stuck or got hit by a hailstone or something, and something broke inside of it, and so it's not working right, and that would probably stick out, because if I had 5 thermometers out there and one of them is saying that it's 60 degrees, and the other 4 are saying that it's 85, probably closer to 85. I don't know what's going on with the one that says 60, but it's probably closer to 85, right? So the reason for my little story there is there are various approaches to calculating the cost of retained earnings, and they all have some limitations to them. None of them is perfect, but hopefully they give you some degree of consensus about generally what that cost of retained earnings or cost of equity coming through retained earnings would be. So first off, I could use kind of that rearranged Gordon's model. So this would be a constant growth model. That would tend to work better if the company is actually expected to grow at a relatively constant rate of growth, which doesn't apply to many companies very often. But I could do that. If the company pays dividends, they got constant growth, that's a possibility. Another approach would be to use the capital asset pricing models. That's what I have down here. So for that, I need beta, I need the expected return on the market and the risk-free rate. So the good side here is I can probably come up with an expected return on the market. I could probably get a risk-free rate. Beta is a little bit of a question mark here. I can calculate what the beta has been, but that's not necessarily a guarantee of what the beta is going to be or what investors expect the beta to be. So that could be a little bit of a limitation there. Now, theoretically, I could collapse that down to the risk-free rate plus the expected return on or expected risk premium on the market times beta. And all in all, we still do have some questions about, what would I put in there for the expected market rate? Different investors might have different thoughts on that at different points. So, that's a little bit of a concern here. This is not like an equation that I can know exactly what I should put in every last minute. There's judgment that's involved here. Or I could say, take the risk-free rate and say, well, a share of stock is clearly more risky than something that's risk-free. So I can take the risk-free rate and we can add on a risk premium. So add on something above that. So if the risk-free rate is 4%, well, if I'm looking at stock, I better get more than 4%, right? So I have to add on extra here. So some kind of risk premium. The question there is, well, how much of a risk premium, right? How much more should the company or should shareholders get for taking on the risk of the company? And that's a little bit of an open question. And I could also look at the yield to maturity on the company's bonds. The good side here is I can calculate the yield to maturity on the company's bonds. So I know that number. But then I have to add on a risk premium. And the idea here is that the shareholders have more risk than the bondholders for a given company. So I could figure out the yield to maturity, but how much of a risk premium? That's a little bit of an open-ended question there. But I could try to come up with a risk premium for that, and that would give me a cost of equity as well. So the idea behind all this is there are multiple different ways I could try to get to a cost of retained earnings or cost of equity. None of them is perfect. They all have limitations. They're all going to be based on some kind of assumption. There are challenges to this. And if you did multiple different equations, don't be shocked that you get slightly different results. Hopefully you get a variety of results that are relatively similar. And that gives you a pretty good sense, kind of like my example. You stuck 5 thermometers outside. They probably aren't going to all tell you exactly the same temperature. They might be off by a few tenths of a degree here or there, or whatever. But you would have a really good idea what the temperature is, right? So that's kind of the idea behind this. There's no one perfect way to find that cost of retained earnings or therefore the cost of equity coming through retained earnings. Okay, hopefully this video about the cost of equity has been helpful. Thank you so much for watching and have a great day.